As we work with clients who are interested in purchasing a business, there are a number of issues that we consider together. Usually, buying an existing business is less risky than starting a new one. New businesses have a notoriously high failure rate, but when you buy an existing business, you take over an operation that's already generating cash flow, which makes obtaining financing much easier. Bankers and investors generally feel more comfortable dealing with a business that already has a proven track record. You'll also have an established customer base, employees who are familiar with the business, and hopefully a familiar location with a good reputation. It's nice not to have to reinvent the wheel, setting up new procedures, systems, and policies, since a successful formula for running the business is already in place. On the downside, existing businesses can be more costly and a lot of due diligence is always in order. One of the first questions to ask is, why is the business for sale? There are any number of reasons a business owner might sell, but you still want to listen to their reasons for selling. Of course, part of our motivation in asking is to look for any signs that might suggest that the business is encountering challenges. But another reason for asking is to help us determine whether the seller may be able to assist with financing in some way or another. Of course, there is a lot of due diligence to be performed. It's customary to look at the company's books and records for the last 3 years. This would include the business's tax returns for that time period. The seller may exaggerate the business's performance to you, but they probably haven't overstated their income to the IRS. You'll need to determine whether the business owns or leases the location where business is conducted. If it's leased, you'll want to take a close look at the terms and the length of the lease, including an understanding of any common area maintenance fees. If the terms have too much uncertainty, you may consider renegotiating the lease as a condition of acquisition. You also need to assess the company's reputation and the strength of its business relationships. Talk to existing customers, suppliers, and vendors about their relationships with the business. Contact the Better Business Bureau, industry associations, and licensing and credit reporting agencies to make sure there are no complaints against the business. There's more that you will want to consider, but this can get you started, along with the help of an experienced coach.